And with me here in studio is a special guest co-host. He's with me for the hour. It's Tobias Levkovich. He's the chief U.S. equity strategist for Citi, and he's expecting stocks in 2011 to, I don't know if we can say rally, but to creep up, maybe 4.5%, which is actually one of the more pessimistic forecasts of the strategists that we keep track of here at Bloomberg. And for this year, Tobias, you were saying, what, 1175 by year end. Does that mean Santa's going to
fall back in the next week?
Yeah, Santa loses his steam for the next 2 weeks?
One of the things we've seen is some of the, if you want to call it fuel for next year, has been pulled forward in December. And I think a lot of that has to do with the Bush tax cut extensions, the new factors that we really didn't anticipate in there, things like the payroll tax, the business write-offs on capital investment, extension of the unemployment benefits. Right. Those are all more positive for the 2011 outlook in terms of GDP and ultimately earnings as well.
Yeah, and we've seen economists increase their expectations for 2011 GDP because of some of those.
We had actually raised, or Citi's economists had raised their expectations a couple of weeks before the bill actually got passed, believing that some things would extend. But beyond that, it's probably even more strong or more strength coming into this. For example, we've seen ranges from half a percentage point of GDP to a full percentage point of GDP. To put that in real kind of stock market perspective, in very rough terms, and again, this could be a little different at inflection points, but in very rough terms, 1% change in GDP is about a 4% change in S&P 500 earnings. So this is a more positive earnings environment than most investors were anticipating, and the market's getting wind of it and pricing it in.
Yeah. So when do we hit that snag? Because you're talking about for 2011 really just being around where we are now.
Well, I think the first half will be stronger than that. In other words, our 1,300 target probably gets exceeded in the first half. Yeah. We're going to get some pretty good economic data. We're seeing it from credit conditions. We're seeing it from various surveys. If it's the National Federation of Independent Business, if it's the Business Roundtable, there's definitely more confidence showing up in the business community to spend some money and hire some people and get things going. So I think we're going to get that bolstered in the first half. It's beyond that. As we move to the second half, kind of think around mid-year, we may see some margin problems start to crop up, and markets will care about that in a more negative fashion. So it's a bumpy ride.